Hi everyone, and welcome to this special LinkedIn Live event where I've got an amazing guest and friend of mine, Catherine Cashmore, who's going to talk to us about why the data is pointing to boom times in the property market. Now, Catherine, when we had the idea to do this LinkedIn Live event, the data wasn't pointing to boom times in the property market. And now, after CoreLogic has come out and said, twice there's been some price increases, we kind of look like we're pitching our flag to a safe bet, right? But you were seeing signs that even late last year that there were boom times ahead. Can you talk us through that?
Yeah, we shot ourselves in the foot a little bit because for so long the media was telling us, well, the media was out there really until the beginning of this year saying that the market was going to crash 15 to 20%, even 30%. I think Christopher Joy had one of the most bearish forecasts out there. And he actually went up head to head against the cook, Stephen Koukoulas, who was saying right from the beginning, no, it's not going to be that bad. And I also said right from the beginning that it's not going to be that bad either. But the market actually started to show signs of a turn late last year. And so when I was writing, and then we spoke earlier on in the year, and I was sort of saying, look, the turn's coming. There's going to be a turn, and by the time we get to the second quarter of this year, we'll start to see the median prices rise. It wasn't through any, I wasn't looking into a crystal ball or anything. I mean, it's just the fact that I work in the market. I know how to analyze the market, and I know how to look at the data that gives leading indicators as to what's going to happen. So that was our conversation and our bright idea to come today and say, yeah, the market's going to turn, but we can't actually talk until after Easter. So here we are. It's good that we get to warn people of this.
I'll have to submit some documentary evidence that we were definitely talking about the market booming well before. In fact, in the midst of property price decreases as presented by CoreLogic. But talk to us about our fascination with the correlation relationship between interest rates and property prices, because we're kind of expecting now. With the sort of mainstream real estate view is that the market is bottomed and interest rates are going to drop. The interest rate futures, their pricing drops in, and I think it was August, September last time I checked, and the market's going to boom off the back of that. But you sort of take a different view on the relevance of interest rates and property prices as a connected data set.
Yeah, I mean, there's no doubt. It's very logical to think, interest rates go up, people can borrow less, it's going to affect the property market. And to some extent, that is absolutely correct. It does. There's two major things that affect the property market. One is the tax policies, because that's what gives people the incentive to speculate on property. And we tax wages and productivity very high in this country, and we actually have, in comparison, very low property taxes. And of course, you can gear your property against and lower your income tax as well. So property is used as a hedge for that matter. And then the other is credit. You need some kind of access to credit in order to produce the fire under the property market. But I guess the first thing to take into account that there have been long periods historically where property prices have increased alongside interest rates. In the 2000s, most recently, they did. Interest rates were rising through the period into the peak of the cycle, which was at the beginning of 2008, alongside property prices. There is a point where interest rates become too high for the productive sectors of the economy to afford the debt. So at some point, if the RBA continued to hike interest rates as it was doing, there would have been a point where it would have cracked to the market. So it's not that they have no effect on the property market. It's just taking this one thing into account, and that is that you can't analyze the property market through a single lens of interest rates. If you really want to understand how it works, you have to have an understanding of the historical cycle, the land cycle, and how that plays into it, and also all the other drivers that are happening. I mean, one very clearly is the difference between what's happening in various states and territories across Australia. I mean, through the first half of this cycle, say, the increases from 2012 to 2017, all you saw the media write about was that there's a massive boom in the property market. And of course, every day for decades, we've been reading about how housing unaffordability problems. But the boom was only occurring in Sydney and Melbourne. You weren't seeing any boom in Western Australia or Adelaide. Those states were going nowhere. Even Brisbane was pretty stagnated through that period of time. So the capital city markets elsewhere weren't booming. And similar to what's happening now, where you see that Sydney was affected most by interest rates. It's the most expensive market. That was understandable. But in WA and in Adelaide, those markets were doing fine. And I do a little bit of buying in WA for clients, and was being told by agents all the time that, well, you're up against 18 other people on this property. You're not the only person trying to buy this home. But of course, there's other things that play into it. The tax changes, immigration that's coming in, the amount of supply that's on the market at any one time. So those short-term dynamics really play in, supply-demand dynamics play into it as well.
Yeah, that's a great answer. Basically, that says there's more complexity to it than one little metric that's going to be able to tell you exactly what's going to happen. Otherwise, we'd all be billionaire real estate investors. Something that popped out for me was I suppose a trigger word that you talked about that a lot of people have been talking about, and that is immigration. We've got a labour shortage in many sectors. I've heard people say if you don't have a job now, it's because you don't want one. We're record low employment, so we do actually need immigration for the workforce, but we're in a situation where we've got crisis levels of rental accommodation. What do you see the impact of this boon in immigration to the property market?
Well, first of all, the big lesson from that statistic is that whether you've got Liberals or Labour in power, they have one agenda, and that is to support and make the economy boom. And our economy is choreographed around the housing market. The banks in the boom phases of the cycle will over here lend around 80% against housing, against land as collateral. So whether it's mostly residential land, and all the industries that are choreographed around that, which have been termed by some economists as the FIRE sector, the finance, insurance, and real estate sectors that are choreographed around it. But everything else, the furniture companies, there's a lot of real estate wealth on the stock market, and so the governments understand. And I know this from my role. I'm president of Prosper Australia, as you know, which for anyone who doesn't understand what Prosper Australia is, it's actually Australia's oldest economics organisation, but it's a tax reform think tank. So we work very hard on policies that will make land affordable. So I spend a lot of time talking to policymakers and governments and treasury departments, and so I have a very acute understanding of this, and that is that they will concoct a way in a falling market or a market that is struggling to increase property prices. And that's exactly what the Labour government are doing. So immigration coming in at record levels, which has stunned everyone. It was like what, the amount of, tinkering that's going on behind the scenes to ensure that we have students coming in. And then, New Zealanders have also been given a green light in excess of where they were, against a housing market, which is showing record shortages. So because the rental market, you're a renter before you become a buyer, and the joke is that I hope they've packed a tent because there's nowhere to live. And they're coming in mainly, obviously, to Sydney and Melbourne. Melbourne's vacancy rate, I think when I last checked, was around 0.8%, which is just a record low. Sydney obviously is really low. WA is very low. They want immigration to come in, and so then the government's got this future fund, this future housing fund, which actually isn't supplying any housing. It's just paying money into a fund that's supposed to supply housing. So it's not like they're running out, buying up acreage of land, subdividing it and selling it off to home buyers, actually, as they do in other countries like Germany, which is one of the reasons that their property prices remain affordable. And so that's one way of ensuring that you have an offsetting factor against increasing lending rates, because of the inflation that we've had as well. You've got building materials that have soared. The prices really haven't come down yet. As you say, we've got labour shortages. That's going to take a while to correct. And so that, again, supports the established market because it's more expensive to build a property than it is to buy a property. So the demand is going into established property, and the demand's not going into any vacant land sites or, when I'm working on the ground, nobody wants a site where the home has to be, it's a knockdown property or needs extensive renovation. And then on top of that, the most recent announcement from the Albanese government is that they're extending the first home buyer grant to include, you can now chum up with a mate who's never bought a house before and get access to the first home buy grant, which is causing a lot of hilarity on Twitter as people are asking if their pet that's never bought a property before, if they join up with their pet that's never owned a property, can they have access to the first home buyer grant? My cat's never owned a house, and maybe the government will give me some money so we can buy together. But yeah, I mean, that's not government that is really caring about an economy, a thriving economy. Look, at a thriving economy, the only way that you have a thriving, diverse economy in any country and avoid this kind of boom bust cycle, which is what we're talking about, why prices are booming again, why they're going to bust 20 to 25%, is you have to take speculation out of the land market, which is a monopoly market, and you have to encourage people instead to pour their investment into productivity, the real economy of making things and working. So, yeah, I mean, those are the factors that really are, leaning against the cash rate rise, along with all the fancy mortgage products that you've got out there as well, the offset accounts where people have squirreled away funds and, are able to buffer against it. And then, the people that fix their mortgages in advance. So actually what we've seen now is not the full impact of those rate rises because of that. It's not that full impact hasn't come in on mortgage owners yet.
If we can sort of put interest rates off to the side, because as you say, there are a lot of people that aren't going to be affected by that because they're not necessarily on a variable interest rate. They might have a fixed term. We've talked a bit about the mortgage cliff, and we've sort of seen that before, and that seemed like a little bit of a beat up, and we're now seeing a record increase in refinancing. And so it feels to me like that's a little bit of a beat up as well. But no matter what happens there, we're likely to see interest rate cuts, and we know that that's going to stimulate the property market in some way, shape or form. People I know investors that are looking to extend their portfolio and they just can't borrow more because the serviceability calculators on current interest rates aren't going to make it stack for them. But when you were looking at the data, when CoreLogic was reporting that we were still getting price declines, and the subject of this very live interview, why the data is pointing to boom times in the property market, what could you see that was leading you to believe that we were about to see a big growth in property prices?
Well, all of those factors I mentioned were one reason why I knew that the rates wouldn't have such a severe impact on the economy as people were prospecting. But there were other things that were indicating that the market was turning. Really, the indication was that it had bottomed around the middle of last year into winter last year, around that kind of June, July time. And then it started to improve as we got to the end of the year. And I know people really scream at me, particularly on Twitter, when I tweet out auction results. And I get this, like horrific reply of, like, how dare you? Like, or there's so many unreported results. No one really trusts real estate agents, and rightly so, even though I am a real estate agent myself. It's understandable. The industry hasn't really built itself up a good reputation over the years. But the fact is that the first thing that you really see that there's a slight change in sentiment on the ground is through the auction rates, even if there's low volumes, and it's got an absolute solid history of giving you that indication, apart from, of course, during COVID, where the auction market shut down, and actually it made us go blind in Melbourne for a while of really what was happening, because transactions were going on behind closed door and you couldn't really get a feel of it. So this is very applicable to the East Coast, obviously to Sydney and Melbourne. But the auction clearance rate started to tick up toward the end of last year, despite the fact that they were preliminary results and they were unreported. And also on the ground, there were a lot of indicators on the ground where it had gone from, agents just not being able to shift stock to, a little bit more demand that I was seeing on the ground when I was dealing with clients. And so at that time I said, look, there's these indicators that the clearance rates have stopped falling. There's a little bit more demand on the ground. And then, of course, we've got all these other indicators where we've got immigration coming up, the borders opening, it looks like at that time, as we were approaching the end of last year, that we were getting a peak to inflation data. And so, that there was prospecting then that the RBA might not raise as much as they were going to. And as soon as we got to the beginning of this year and the clearance rate data continued to improve, it was just a no-brainer to say the market's going to plateau and it's going to improve into the second half of this year. It was really obvious to anybody that worked in the market. Now, it doesn't matter what your opinion of real estate agents when you look at clearance rate data. It doesn't matter what your opinion is of the unreported results. That is just been a solid indicator. And if you start to see that those rates improve, that's great. If you don't like the data that comes out from Domain or CoreLogic, you can look at SQM. Louis Christopher, who produces his from SQM Research, who puts out very reliable data, and then just monitor whether the percentage, the clearance percentage is going up or down, and it will give you some kind of forward indicator that will come in then on the median data, which is a little bit laggy. And then actually, I used to have a lot of criticism against the CoreLogic daily price index. Years and years ago when it was first devised and came out, I wrote a few articles, saying, this is just like this daily indicator of prices. But it's actually pretty good now if you monitor it each day on where the monthly data will be. At the end of the month, it does give you like a little bit of a hint of monthly data. And of course, then that monthly data adds up to the yearly data. And so that will give you a hint that the market's improving. Now, having said all of that, it doesn't mean that we've turned into boom times. It doesn't mean that the market's roaring like that turn that we saw in 2019 after the Royal Commission. And that was a really harsh downturn, harsher than we've seen over 2022. It doesn't indicate the market's moving. It indicates that we're coming into a plateau. But that, alongside the fact that the RBA have stopped increasing rates, alongside the fact that we've now got home buy grants coming in, which is fire at the market, alongside the fact that we've got governments and I probably shouldn't say things like this, but it's not just the New South Wales government that is looking into the change of stamp duty to land tax. There's other governments that are actively doing that at the moment. So alongside all of those indicators that are coming on, that all adds fuel to it. The immigration, the shortage of property, the fact we've not been building enough. It is a genuine shortage because of where the vacancy rates are showing us. So there's a lot going on. In the short-term supply-demand dynamics that are really indicating that we could, by the time we get into 2024, really see strong market into 2024, 2025, and into 2026. And that correlates with the land cycle that I write about. So that was the other factor that kind of informs my decisions as well.
Yeah. The land cycle is a really kind of inscrutable thing for me to understand. And every time we go away from a conversation, I realize I'm probably never going to do an economics degree. But talk to me about the land cycle, and you're able to cite data that shows land cycle over a period of, what are we talking, 200 years plus, I think, from memory. What was it about the land cycle that was pointing to this being the time of another boom in land prices, or, for want of a better term, house prices?
Yeah, and don't put yourself down, Mike. Someone that flies planes and does all of that, that's got a pretty sharp mind. The land cycle has a very robust and long history behind it. Hundreds of years of history. You can trace it back in America to 1800, when America started, around the time America started to sell off its land, subdivide and sell the land. And you can trace it in England back to the 1600s. I've traced it in other areas of Europe back to that same date. These are from countries that have long-term housing indexes. So, for example, there's a very long-term housing index in Amsterdam. In the UK, an economist and very good friend, Fred Harrison, has traced the cycle back to the 1600s and written some amazing books on it. It's kind of like a secret, really, because it's not spoken about in the mainstream much, but it's certainly not unknown. It was discovered in the 1930s by, I would say, arguably, there were two men that discovered it around the same time and published books around the same time. One was Homer Hoyt, who wrote 100 Years of Land Values in Chicago. in 1933. And he was looking at the development of Chicago, which was a rapidly developing city at the time. A lot of building activity, a lot of population growth. And he traced the data back into the 1800s, and he identified these cycles of booms and busts, which happen around an average period of 18 years around them. Roy Wenslick also did some excellent research on it. Anybody that signs up to my publications, with the link is in the chat, will be able to read about some of these. Roy Wenslick, I mean, Homer Hoyt has a Wikipedia page about him, and you can get his book online, and you can find places where you can download it. Roy Wenslick has pretty much been written out of the history books, but he was prolific in his time, a prolific writer, a real estate valuer, worked in his father's real estate company, did a lot of research on the land market, and he discovered that the cycle really was across Australia, across America, across the America. And he wrote a book called The Coming Boom in Real Estate and What to Do About It. Well, it was a pamphlet, and it was made the New York Sellers bestseller list, and was extremely popular. Now, at the time, people were still in the depths of the Great Recession, which was a terrible, recession. I mean, it was like not even on a par with what we see today in a recession. I mean, people were homeless. They, the stories that you read about that time were really devastating. And of course, out comes this real estate agent and says, nothing's changed, has it? And says there's going to be a boom, and told them when there was going to be a boom, and when the market was going to crash. And of course he got it absolutely right. He became so famous for his work and his charts and his analysis, and of course he had also identified this cycle of an average of 18 years over a period of time. Many other economists and historians did identify it as well. It just never made the mainstream for a few reasons, really, and that is that once you identify it, you really understand what the cause of it is, which is, as I said at the beginning, speculation. You can stop speculation in the housing market really simply. Tax land. You can change the economy by moving the tax base onto land. Tax land, you employ land into use, you reduce the price of land because land cannot be created. So if you have to pay a heavy tax on a block of land each year, you're not going to pay as much in the price. You're going to calculate that into what you will pay for it. You reduce rents because it employs building activity on land, and then untaxed income and productivity. That was what the old classical economists used to advocate. Henry George and John Mill and Thomas Paine, and Adam Smith, just like first, yeah. Yep. Names flying in and out of my head. But yeah, I mean, that's what they would advocate, to untax wages, encourage people to work and tax land and stop people from speculating on land and use the land market, appropriately. And of course, the people that wrote about this land cycle were very well aware of these economists and understood this. And they recognized that there was this cycle. I guess to make it applicable for Australia, because the history is very interesting and we could talk about it for ages. But for anyone that's listening, this is how I explain it to my clients. If you go back to the last land-based led recession, which was in 2008, so it was the GFC, and you go back 18 years from 2008, you get back to 1991, which was the recession we had to have, how it was termed in Australia. And it was another very bad land-based led recession, which hit Sydney and Melbourne very harshly. If you go back 18 years from there, you get back to 1973-74. It was known as the OPEC crisis, but it was also a very bad land-based led recession. Again, affecting the East Coast quite badly. The commercial markets in both of those recessions were smashed, particularly in the early 1990s recession. So it didn't just affect the residential market, it affected all real estate. You go back 18 years from there, you get back to 1955, which was a recession. It wasn't so bad because it was after the Second World War. So there'd been less speculation in land and the creation of suburbia. So people had moved out and there was more land to absorb the population. So it wasn't such a volatile cycle. Now, the two world wars prior to that, they did interrupt the cycle because people weren't speculating on land. They were on their feet and going out to war. And so there wasn't money in the economy to speculate on land.
I had a bit on.
But prior to that, the cycle is very consistent back to the 1800s. Now, in Australia, we've had long periods in our history where we haven't had speculation on land. We had a very bad crash in the 1840s, which was at the end of the 18-year cycle, and then the economy didn't recover until it did in a boom into the 1880s, and then the 1890s we had that was the gold boom and bust, and that was a very severe crash. It was the worst depression in Australia's history. Our economy was, obviously it affected Melbourne and the areas where there was gold. Then we didn't have another boom and a bust until the 1930s. We crashed very hard into the 1930s at the end of the 18-year cycle. And then we didn't. And then the last three cycles prior to the one that we're in now, we have correlated in. So we correlate quite consistently with that cycle now because the economy is globalized, and so that cycle does persist and exist certainly across the West, in America, in Europe, in Australia, not so much in Asia because you can't own and speculate land as we do in the West. In Asia, it's a closed banking system, and it's a very interesting and fascinating cycle to follow. So that's how I knew that we're in the middle of that cycle now. If you'll allow me to go on a little bit, hopefully no one's getting too bored with this, but there are two recessions in the land cycle. One is at the end of the land cycle, which is where I'm talking about. That's the crash, right? At the end of this, you have around 14 years of rising land prices on average. It can vary by location. And then you have a very sharp downward turn. Now, this is in land prices, in property prices, if you chart it. There is a recession, however, that comes in the middle of the cycle. So there's one that comes at the end and there's one that comes in the middle, around 7 to 9 years in. And that is what we term a mid-cycle recession. It can be a very severe recession or it can be a mild recession, but it will not affect the land market, but it punctuates the 18-year cycle. And so the last mid-cycle recession we had was the COVID recession. Very bad, but the banks were better able to weather the storm. There'd not been as much speculation in land in the lead up. We didn't have a land price collapse. The one prior to that was the dot-com bubble in 2001. So that was between the 1990s land crash and the 2008 land crash. In the middle of that, there was the recession, the dot-com bubble. We didn't go into recession, America did. It was a mild recession, didn't crash the land market. The one prior to that was the early 1980s, prior to the early 1990s land-based led recession. And that was a very bad recession. Our unemployment rate really soared, but we recovered quickly. It didn't crash the land market. So now, if you go by that cycle, we're heading up to a peak in 2026. And then we would expect unequivocally, in my mind, to go into a recession into 2028. And the reason that I knew that we're heading into a bullish market outside of where all the stats were, because it can depend locally, you have to have those factors to it, is because historically against that cycle, the most bullish part of the cycle is the second half of the cycle, and particularly the last couple of years. And that has stood in Australia, in Melbourne and Sydney, and to some extent the other states as well. It just depends on locally what's happening there. But and so I knew that we would, if the cycle was to hold, we would be heading into a very bullish market. And I expect that bullish market to be between 2024 and 2026.
Yeah, wow. We've had a comment from Casey saying he's loving the chat. A comment from Justin, who's on board as well. Chris McNaughton is calling you a talking encyclopedia, which I think is a very strong compliment from Chris. If you do have a question, if you do have a question for our talking encyclopedia, stick that in the chat. But I'm going to ask you that annoying question that everyone asks that sort of involves a crystal ball to some degree. What for people that are perhaps watching this, or that they are seeing the data themselves, or they're seeing the energy on the street, they're seeing people fighting over good quality investment stock. For people that are wanting to take advantage of what's likely to happen in the property market in the next little time, what's your best advice in terms of timing, how it differs from market to market, the different types of investment opportunities there are, whether it be some simple things like house versus units or regional versus cities? What does the data and your experience tell you for people that are wanting to get the most that they can out of this period as an investor?
There are two ways to take advantage of it, in the property market and also in the stock market, remembering that the stock market plays along with this cycle as well. So when I'm talking about at the end of that 18-year cycle, there being a land-based led recession, there's also a stock market crash that comes prior usually to the land market crash. In Australia, and you also see the stock market obviously downturns in the mid-cycle as well. So understanding this cycle, to me, it's the most important cycle that you can learn. Land is the gravity to the economy. It sits at the base of the economy. Everything around us is made up of land. You know, everything, we eat from it, work on it, sleep on it, rest on it, play on it, bury our dead in it. And so it's the most important factor in our economy. And of course, as I said, the economy is choreographed around it. But when it comes to, so bear that in mind for the stock market as well, that the stock market will play alongside this cycle. And a lot of what I write at Land Cycle Investor and in my other products that I write talks about how you can take advantage of that. But in the land market, you need to remember that the value is in land, not in the building. The buildings depreciate, the land depreciates, as I'm sure anyone that's listening will understand if they're in the real estate market. And if you look at the long-term stats, unequivocally, land, suburban houses, the old suburban house on a block of subdividable land will outperform in capital growth, generally speaking. It's not that you can't find outliers, the small, single level dwelling in a school zone, for example, that performs well as well. But generally speaking, that is if you're chasing capital growth, which is really land price-led recession, land price-led inflation, because capital depreciates, it's man-made stuffs, then you need to invest in the land component. And land is worth its location and it's worth its zoning. So it's valuable because of the location that you're in. It's the location that gives land its value, what surrounds it. So it needs to be in a landlocked location. And by that, I mean an established suburb where there's population growth coming in. And you can see, if you take a bird's eye view of that suburb, that the land blocks are being increasingly subdivided into 2, 3, 4, and 5 to accommodate that population coming in. It's one of the signs that the developers are making money. And as the land is being built out and built up, the existing land sites that have not been subdivided and sit there with the old suburban houses on are becoming more and more valuable. As the old economists used to quip, the owners are growing rich in their sleep without working or economizing. And we still know that happens today. We've seen, anyone who works in the property market will have seen this. You hear the old spruik that property prices double every 7 to 10 years. And well, they're taking it off median data, because median data doubles every 7 to 10 years. Property prices, individual property prices, I've seen some of them treble this type of investment over a 10-year period. So it really is a boom bust cycle for that. So you need to look at that, but you need to understand the zoning of the land. You cannot buy a block of land that cannot be subdivided with a property on it is no better than buying a unit. It's what you can do with the land that gives the land its value, aside from the location. So the zone, and so my advice to anyone, if you're chasing capital growth, you need to chase something that's got a land component and to buy that type of property. On the other end, the properties that do not attract capital growth and that you should stay away from, unless you're trying to diversify your property portfolio into more of a cash flow portfolio, of course, it's apartments, because they are, being increasing in supply. There's only a small demographic that live in apartments, and there's only a small demographic that buy apartments. Essentially, your property is only worth what you can sell it for. So whatever property you buy, you want to have the broadest buyer demographic as possible interested in that property. If you've got young couples, people that are upsizing, family buyers, because they're our biggest buying demographic, family buyers with children, family buyers without children, thinking of having children, somebody who wants to put the property in their super fund and land bank it, whatever else. If you can have a range of people interested in the property, then in the volatile periods of the cycle, like we've just seen now in 2022 and like we saw in 2018, in those soft markets, if you need to sell the home, then it's got a better chance of holding up against it. You've got a better chance than if you're buying a very highly priced property or an apartment or whatever else, if you can keep that in mind. So that's in general, my advice for property investors.
Yeah, I think that's great advice. And not just the land part of it, but the scarcity or the location and the utility and what can actually be done with it. And I think there's been a few times where the land to asset ratio has been mentioned. It's become sort of quite a mainstream thing, and I think people like David Johnston, talked a lot about land to asset ratio, and in the Property Buyer and Professor podcast, which I'm now plugging because the professor has retired and I've gone in and it's the Property Trio, so I'm giving that a plug. That talked a lot about, and I mean, I can't even get any credit for that because it was before I started. They talked a lot about the value of having, a large component of land value as a proportion of the total value of the asset itself. I've got just a question from Justin I'm about to chuck up. And if you've got a question, now is the time to put that through, and I'll put that to Catherine. I apologise for the technical issues on my end. I seem to be the only one experiencing it, so there's a little bit of a delay between where Catherine finishes and I'll ask her the next question. But we're getting through it, I think, Catherine. I've got a question from Justin Gill on LinkedIn, who's saying, what do you see moving with new homes versus existing in the next 2 years? Inflation on materials is making it challenging for the price of building new homes. We're seeing data from the Australian Institute of Quantity Surveyors saying that they were expecting a 4.3% increase in material prices up to October, and that data is probably 2 years old. So that's still a big increase, but the pace of increase had been slowing. We've talked about before, you basically saying that it's these existing well-located lots of land that are seeing the best capital growth. But what's your view on new versus existing in the next 2 years?
Yeah, I mean, I never buy new if I'm looking to get capital growth. And that is because in the new housing estates, I mean, if I just take Melbourne, which is where I'm located, Melbourne rezoned its land a few years ago to try and stimulate higher density. And then for the first time in Melbourne's history, we were building more up than we were out. And what they did then is they put this permanent urban boundary around the city. And within the urban boundary, the big housing development companies went up and they bought up the land on options. So they were in the studies that we did at Prosper. They were, they had something like 14 to 16 years of land supply that they were sitting on. And then they drip feed it onto the market in what they call staged releases. And they cut the land component down very, very small because they want to maximize, obviously their holdings and what they can get out of the price. And then they build to the boundary. They build these new properties on them. And those new properties, of course, they depreciate very quickly. And not only do they depreciate, but the land continues to get to be drip fed onto the market. So new supply continues to come onto the market and it waters down those prices. So if I take, for example, Tarneet, which was a new suburb in Melbourne that I remember when it was first developed and the land companies they started to develop it and prices went nowhere. And there were these stories that came out in the papers at the time that were saying that these people have moved into Tarneet. There's one road that goes in. There's queues to get, it's taken them, rather than the 45 minutes spruiked, it was taking them hours to get into the city each day. And they wanted to move out, but their properties weren't worth any more. In fact, if anything, they were worth less. Now, Tarneet now is doing well. So there comes a point where the land has been built out and all the new, and then the council are under pressure to provide community facilities for the increased population. So then they for example, in Tarneet, they put in a train station. As soon as they put in the train station, you started to see that land price inflation. So you can buy in a new housing estate and you can get the tax depreciation benefits. If you're looking for positive yielding property, it will give you positive yield. I would never do it. I think that there's better ways to get positive yielding property that will also give you decent land price appreciation. But you just need to bear in mind that the depreciation of the property component of the site is going to depreciate faster than the land component of the site can appreciate to offset that difference, unless you're in a really boom market. And that's just been the way that it is in Australia. There's been very few overseas markets where new property will always be better to purchase than older property, but not in Australia. Yeah, I mean, that's my general feeling on it. In terms of the building activity, I mean, there's no doubt that we're going to, as soon as, as the building materials, as that resolves, and that as we get the immigration coming in with labour, we will head into another building boom. I mean, there's already quite a lot of building activity going on, like, in the apartment sector and everything. There is stuff going on in the cities that was activated during COVID. So a lot of projects that were approved at that time. So there's a lot in the pipeline, if you like. So I mean, I really feel that, when we get into 2024, 25, 26, you'll start to see that kind of building boom ramp up. And the other really interesting thing about the cycle, which is a bit of a pop indicator that people can sort of follow, and that is that the tallest building, the opening of a tallest building regionally and absolutely in particular worldwide. So when you hear the tallest building in the world is being developed in like, I think it's the Burj Khalifa in Dubai was the tallest one that was built into the peak of the last cycle. When they open in when the market is in recession. So you can almost time the cycle by the tallest buildings being developed. So we had Australia 108, which was the tallest building in Melbourne that opened into the 2020 COVID recession. So I mean, don't go and buy new apartments off the apartments, whatever you do in these tall buildings, just be a little bit careful.
Yeah, I mean, stay in an Airbnb that someone else has bought if you're interested in, the fun of being in a very tall building, but you don't necessarily want to own it yourself. And you raised a really interesting point about, the depreciation benefits of a brand new property are obviously fantastic. And as a depreciation guy, we'd love to see that, because that's where we can really massage as much as we can. But that can't outpace the benefit you get from depreciation. Can't outdo the fact that the land is not performing there because you've just got that sheer amount of supply. And I always say depreciation is a bonus. It's not a strategy. And personally, I've never bought a brand new property, even though I could give an absolute hiding with the depreciation schedule. I'm more interested in the growth of the asset over time. I'm going to make one last call for anyone who's got some questions for you, Catherine. And in the meantime, I'm going to ask you that crystal ball one that I sort of feigned at, but I'm going to chuck it back at you. What could likely happen in the next 12 to 18 months? Is it a sure bet that we're going to see double-digit growth? I mean, what is possible? And I know that there's markets within markets, but very recently we've especially in COVID, you could almost talk about the property market as one entity, because everywhere was kind of going up. And is it something like that we're going to see again?
Yeah, that was such a unique time, wasn't it? I think it was the first time in Australia's history that you could say that every market in capital city and regional market was rising at a phenomenal pace. And of course, there were all sorts of things that played into that. And the regional markets, because to get price growth in any area of Australia, you will see certain things that signify you're going to get that, and that is population growth into an area that has limited accessible land supply. And of course, what happened with the regional locations, that's what you saw in COVID. A lot of people moving into these areas where the supply could not accommodate. You had less people leaving Australia because it was very difficult to leave Australia or come into Australia at that time. So that kind of migration, and then also coupled with the stimulus and of course low interest rates, everything, it really played into it. But I actually did call that boom in advance. I didn't think it was going to be that huge though. So it was really shocking. I don't think certainly over this year, I wouldn't be expecting double-digit price growth, the markets necessarily to take off and boom, but that's certainly what we're heading into, I would expect, for 2024. I really feel that the market from 2024, particularly into 2025, will be extremely strong. And those are the times that we'll see double-digit price growth probably return to the capital city markets in particular. What will happen I would have really expected, for example, Perth to take off more so than it has. But Perth's a very unique market. I mean, it did very well out of COVID, and there were suburbs in Perth which really did get that double-digit price growth through the period of COVID, like 30% gains. I mean, I remember looking at houses there that were, selling for $1 million in 2020, and then in 2021 they were selling for 1.4 million. I mean, it was just unbelievable, the turnover that was happening there. We haven't really seen it take off since then. It's been going up, and some areas are doing very well, but I would have expected it to do better. And it could be to do with the sales environment in Perth. It's very different from what you get on the East Coast. If you go and try and buy a property anywhere, well, in Sydney or Melbourne or Brisbane, even now, you'll be run up against every buyer. You'll put down an offer, they'll call every other buyer that's been through, they'll make sure that if there are other buyers that they're going to run you up against each other. In Perth, it works very differently from that. You put down an offer, you have to move very quickly, because the market moves pretty quickly there, but you put down an offer on a property, if it meets the vendor expectation, they'll sign off on it. And my experience is that the agents don't really work the market like they do in the eastern states. So I don't know whether that kind of plays into it. I do really feel that the auction markets, because people are seeing properties sell on the street, that really adds to the volatility of the cycle. That you get a lot of FOMO around that when you missed out on 2 or 3 auctions and you've seen everybody else bidding. It gives you confidence that the market's moving, and so people kind of push the market a little bit quicker because of that. But yeah, I mean, that's generally how I would see it over the next few months. And I really feel like you don't know when the bottom of a market is, obviously, until you start to see the signs of a turn. And that's why I would say to people that the market really bottomed at the end of last year, because the consensus now is now we're talking here, is that the market is not booming, no, but it has turned, and it's not taken off. Yep. So now getting in now is actually a really good opportunity. Excuse me for sounding like a real estate agent. There will be a time where it's not a good time to buy. So there will come a point where I won't sound like a real estate agent anymore. But getting in now is actually a good option for people. So I would bear that in mind if you're a property investor.
Yeah, absolutely. I'm getting my ducks in a row to get involved myself. I think it's a great time to buy, and I think we're going to see some price increases this year, and next year will be the big one. And you heard it here first, folks. Double digits from Catherine Cashmore. I think what will be equally interesting. What did you say? Sorry.
Well, for 2024, I didn't say necessarily double digits this year, but definitely we've got the turn this year. And into 2024, we should have that.
Yeah. What will be, I think, very interesting to see is when we see interest rates coming down, and the rhetoric around rents having to go up because investors are paying more for the properties. There might be an expectation that the rental market is likely to soften, or the rental pains will dissipate a little bit, but I can't see any indicator that that's going to happen. And we're already seeing political parties gearing up for interventions. There's been some terrible policies by the Greens recently talking about rental freezes and those sorts of things. Do you think that we could be seeing such a boom that we would potentially see a real strong knee-jerk reaction from federal or state governments to try and sort of deal with the fact that they've disincentivized investors from creating that rental supply, and now we do actually have a rental affordability crisis?
Yeah, I mean, the rental argument really is, well, there's a whole heap of things that policymakers just don't take into account. So, for example, one of the studies that we do at Prosper Australia is we look at how many properties per postcode are being held vacant for a period of 12 months or more, based on water usage data. We've been doing that for over 10 years now, 10, 11, 12 years. We've been looking at that data year in, year out. And in Melbourne, I mean, there's just been there were some years where there was over 80,000 properties that have been held vacant for 12 months. We were prospecting, it was around that time. It's not perfect data, but certainly gives you more of an indication than just looking at the short-term vacancy data. So against that, you've also got Airbnb. The trend for Airbnb is turning a little bit now, but obviously, the market got saturated with Airbnbs because everybody was out of COVID, and that started to boom as well, and that took properties off the long-term market also. So there's policies there which governments could really tackle to not only employ underutilized housing onto the market. They could look at that. What could they do to get some of this housing back onto the market so that it can be used for rental accommodation and not hoarded away? And then there's also the policies really that would get people building more to stimulate more supply. And you can't stimulate more supply from just rezoning land, right? Rezoning land gives the owners windfall gains, aside from anything else, because you've just given somebody a windfall from enabling them to put more properties on their land. And the developers control the land supply. The government doesn't. The developers control how the supply is released to the market. So policies around that for the government to actually take control of the market, buy the land, rezone the land, and supply it for rental accommodation, across the cities would really be a good plan as well. And their housing fund, rather than putting it into a fund, they could actually use that. Dr. Cameron Murray, if anyone wants to Google Cameron, he's done some brilliant research on that. He runs a Substack. He's also very, very good on Twitter. But so I mean, that would be my recommendation for them if they wanted to actually affect rental supply. As it is, nothing that's being suggested is going to assist to move the needle considerably. So you can expect there to be tight rental markets until we get to that point in the market where the actual supply starts to catch up and we get a boom in the market and we get more investors jumping in the market for the sake of wanting gains and buying new accommodation, which actually adds supply to the market and assists those vacancy rates as well.
Well, it's going to be an interesting 12 to 18 months, no matter what happens. Catherine, thank you very much for sharing your time and your wisdom and your talking encyclopedia-ness today. It's always a pleasure.
You're very welcome. Thank you so much for having me on. And thank you that people showed up live and asked questions. That was so nice. So I really appreciate that. Thank you.
It was great chatting to you, and we'll share those links in the chat as well. Enjoy the rest of the day, everybody, and thanks for jumping on board the LinkedIn Live today. Cheers, Catherine.
Thanks, Mike.